Hello, everyone, and welcome to another installment of our Southern California housing market update. This is for November 23rd, 2021. We are in the week of Thanksgiving. My name is Stephen Mead with Domicile Real Estate for people who love houses. And no, this headline is not a joke. I think the numbers are going to speak for themselves. We might have a little bit of kind of a holiday effect, and I'll talk about when they go through there. But I'm sure you are busy running around like I am, but you are never too busy to understand the real estate market. So let's go ahead and let's actually jump right into this. I don't want to wait at all. So, alrighty, let's start. Let's start with our total active listings. What is going on in our Southern California market? Just as a reminder, that is Los Angeles and Orange counties. And would you look at this? Inventory is nosediving. That the steep of that curve, the slope has even gotten stronger. So if you look back here to where was our inventory at the very beginning of the year, January 4th, we were about 5,000 active homes under $1 million. Today we are at 4,500-ish. That is 10% under, and I have a feeling by the end of next month, this number may even be below 4,000. That would be a roughly maybe 20 to 25% reduction in inventory versus the same time last year. If we look here in our 1 to 2 million category, it is even worse. We were at maybe 2,500. We are at 2,000 today. So we're already 20% down where we were at the very beginning of the year. Now, I'm going to go off screen share here for a second. The problem with this is not just that this means we have a lack of available homes, right? That is problem number one. But problem number two is, where does this set us up for next year? So historically, at the beginning of the year, and I don't have any reason to believe next year will be different in this respect. Historically, this is how it works. January comes and goes, usually towards the end of January. The buyers are the first ones to wake up in the marketplace for the spring. They're the first ones to start heading out of the gate looking at houses. It is the sellers who follow them. So what is going to happen if we start off this year with 25% or even 30% in some pricing categories less inventory than we started off with this year? So if 2022 is worse in terms of a starting off point in inventory than 2021, what does that mean for a spring? I think that means spring is going to be very, very brutal. Okay, so let's go through. So we've seen our total active listings. Now let's look at new listings coming on the market. Now, there's no surprise to this, right? The week before Thanksgiving, I think historically has been regarded as an awful time to list your home. This year is an exception to that. I actually think now is a perfectly fine time to list your home. And I'll explain that why in a second. But look at where we are in new listings. This is the lowest point we have been since, again, right, looking back in there in that first week of the year. Also looking here, we are almost where we were at the end of the year in terms of new listings for our 1 to 2 million category. But we are actually at about the same point as we were at the end of the year for our under 1 million. And this is, again, taking a steep dive. I think some of this might be holiday weekend factor or holiday week factoring near. People don't want to list their homes, but I'm telling you folks, this year that is a mistake. And the reason why is this chart right here, which is new escrows in the last 14 days. So despite dwindling inventory, right? Inventory that is taking a nosedive, those new escrow numbers have either held or increased slightly, right? And in fact, if you look here in our 1 to 2 million category, we're not that far off from our high point the entire year, right? This is an upward sloping curve here. So what does this mean when we reconcile supply and demand like this? Well, we get a very, very ugly looking chart like this. Now, again, I think some of this might actually be related to it being a holiday week. I think there's some extraordinary numbers in here, but look at this. Our absorption rate for 1 to 2 million is over 110%, right? The last time we saw that was like the first week of the year where nobody puts their house in the market between Christmas and New Year's. What happens if no one puts their house on the market and houses go into escrow? You end up with big absorption rates. But look at where we are. This is absolutely nuts to be at this price point. This is kind of a, you're going to pay whatever someone's asking to get a house and then some. Now, looking under $1 million, this graph might look a little bit easier, but it's not. We're still well over 100% in our absorption rate. You know, I can't remember if it was 3 or 4 weeks ago, but I did a video and I basically said, warning everybody, I think what's going to happen here is we're going to enter a period of hyper competition towards the end of the year. Inventory is dropping too fast. And that's exactly what we're seeing. We also have another effect that I'm going to talk about that is fortunately a temporary effect that might be bolstering these numbers a little bit. But this isn't all holiday week and interest rate related panic, right? There's some meat to this absorption rate. We are seeing sellers backing out and not putting houses in the market at a much faster rate than buyers are slowing down. In fact, buyers aren't slowing down. Now let's look at closed pricing. Now, I just want to remember, I reiterate this every week, but it's super important to understand, this is telling you where prices were 4 to 6 weeks ago. It is not telling us where prices are today. And that's because this is based on closed sales, which were negotiated 4 to 6 weeks ago. So where are we in our 75th percentile? Yes, it eased a little bit, but look at the shape of this graph. We definitely had a jump here, an increasing slope in price. Where are we on our median price point? Big increase. Where are we on our entry level price point? Increase as well. This is showing some of that level of market competition that we saw 4 to 6 weeks ago. And based on what's happening this week, 4 to 6 weeks from now, we're going to see another price jump. Now let's look at our other measure of competition, right? This is a great reality check, having two different ways of measuring similar things. Remember, lower numbers here mean a more competitive market. So we went through the spring, maximum competition, then things slowly got a little bit better. They leveled out starting in the middle of July, and then they've actually been getting worse as we've entered September. And then, boy, look at the tumble this took in the last week. Yet another sign that we have a market where supply and demand are very out of whack. And there's a lot more demand than there is supply of homes. Here's another measure, right, that tells us our market is more competitive. It is our close to list price ratio. What did we have happen? Let's recap briefly. This year, this number rose as market competition heated up. Remember, this is a measurement where it shows the difference. This is measuring the difference between seller's perception of how hot the market is and a buyer's perception. So when a buyer thinks or is in a much hotter market than a seller thinks, we see homes go way over their list prices. Look what happened in 1 to 2 million. We have shot up to 104%. That means on average, every $1 million house that closed for $1,040,000. Just think about that for a second. Even look at our under $1 million, right? This number started off here, it came down at the peak of competition, and then it really hasn't gotten any better. We would have expected this curve to keep going down here to around 100% towards the end of the year, but I don't see any signs of that happening. Yet another thing that points to kind of a very busy spring. And then we have days on market, right? This is another kind of one of our bellwether measurements, is days on market. We saw days on market start to rise a little bit, but not really. Look at where days on market was at the end of last year. Very high, towards 40 days for under $1 million, in the mid 50s for 1 to 2 million. Where are we today? 21 days for under $1 million and 27 days for 1 to 2 million. We are nowhere near the point we were at toward 12/21 of last year. And then we have our affordability graph. This one, I think, is definitely something you need to pay attention to, right? We had a big reduction in affordability heading through the spring. We all saw those prices run up. Then we kind of reached this 115% level, kind of we're bouncing here, and now we've taken another rise. And I think what happens next week is really, really important, because this number can rise, but this overall shape of this graph needs to be slow and smooth. If it rises too quickly, that's how we end up with an overheated market. So we can't really have too many weeks like we're having this week. Finally, let's take a look at interest rates, and I'm going to give you a caveat. So if you look here, interest rates went back down to 3%, and then they bounced back up into the low threes. Now I'm going to tell you why this is important, because if you are a buyer or seller, really, you're thinking about what's going to happen next year. If you're a seller and you need to sell, especially if you want to buy another house, I would say do it now. Historical wisdom says don't list in December. I think historical wisdom is completely wrong this year. I think December is a great time to put your house in the market. Nobody else is, and buyers are still out there. If you are a buyer, right, here's what you're thinking of if you're a buyer. Interest rates bounced a bit this past week. And the reason why that's really important for you if you're a buyer is because you can watch your affordability erode. So I do think some of the activity this week is sort of that panic buying that happens, right? When buyers feel like they are priced out of their price range and they're going to miss out. FOMO is the strongest market force in real estate. And I think that is a little bit at play here. The real question of our market in the spring comes down to interest rates. If interest rates continue that march to the high threes, that will alleviate some of the constraint, some of the demand that we're seeing, right? That might help put our supply and demand back into balance. But if interest rates move slowly or kind of stay in this 3 to 3.25 type of a range, maybe even 3 to 3.5, I think next spring is going to be gnarly if you're a buyer. I think it's not going to be better. It's going to be worse than it is today. And I think it's going to be worse than this past spring. Now, there are limits to this, right? As prices rise and affordability goes down, that will temper some of that demand. That's the relief valve to prices just running away at 20% a year forever, right? As long as if wages are not going up 20% a year, there's a limit, right, to how much those payments can rise on houses. But I'm telling you, I think with all the data I'm seeing, and I'm curious to see next week and the week after, what I'm seeing here is a market that is farther out of whack between supply and demand. And if you're a buyer, that means, I would be in the market. Keep your eyes open for houses as they come up. I think if your plan is to wait until spring, one of two things is going to happen. Either interest rates are going to stay reasonable or go up slowly, and you're going to find that this market is crazier in the spring, or interest rates are going to rise a lot, and you're going to find the market is better, but your buying power has been greatly reduced. What you get for your payment and affordability will go down. So if you're a buyer, I wouldn't wait. And in fact, if you're a buyer and you're not working with an agent, or you're working with an agent you don't like, definitely give us a call. We are taking on new buy-side clients. We just put a couple of our buyers in escrow, so we have a little bit more room on our schedules for new clients. I'm trying to think what else. Have a great week, everybody. Happy Thanksgiving. I know we're talking fast on this one, but I just want to get you the information as soon as I can. Once again, Stephen Mead with Domicile Real Estate. We've got a link down below if you'd like to schedule a consultation. There's no cost or obligation. Do not forget to like, subscribe, or hit that notification bell, or do all of those, which you should be doing. And we will see you on Friday for our first-time buyer market update, where hopefully we'll have a little bit more news on what direction things are going. Anyhow, thanks so much for watching, everybody. We'll see you again real soon.